Today on Mark Talks Finance, Fed to start tapering bond purchases later this month as it begins pulling back on pandemic aid. With Fed taper expected, investors break for rate hikes on horizon. Now, the Fed has hinted at tapering happening sometime this year for quite some time now, and I'm sure you've probably seen news articles or videos talking about a market crash or an impending market implosion that's somehow a side effect of tapering. But is that really what's happening here? We're going to talk about tapering and the effect that it has on the market and what you should do when this happens. But this might be a little bit of a long video, but I'll try and keep it short as usual. If you do like what you hear, be sure to give a like at the end of the video or at any point during the video. It will be greatly appreciated. And with that said, let's get right into it. Now, whenever there's a recession, the government usually slashes interest rates that banks give on overnight loans, which then allows them to offer cheaper loans. And the more cheaper the loan is, the more money you can take out, which can then be used to stimulate the economy. But then what happens when slashing interest rates doesn't really help, like what happened back in 2008? Now, the next step in this case would be to buy back bonds. A bond is basically an IOU that says, for the money you lend me, I will pay you back with X amount of interest in X amount of time guaranteed. Now, bonds are typically issued by large corporations, but in this instance, we're talking mostly about government bonds and mortgage bonds here. Now, in an economic slowdown, the price of stocks will usually drop, and the natural instinct is to move your cash towards a more secure source of income. And that's where bonds come into play. However, in a crisis, the Fed would buy back bonds, which would drive the price of bonds higher and interest rates lower. Now, in this scenario, it would make little sense to leave your money in bonds because you could get a higher return in stocks since the interest rates will be so low. So this will give investors an incentive to put your money back in the stock market, buy more stocks, which would drive the prices of stocks higher and set the market back in motion. This is basically what happened in 2020. The market crashed, Fed slashed interest rates. On top of that, they also bought back a lot of bonds, which then drove interest rates down to below zero. Now imagine the banks and all lenders saying this. You can borrow some money, but we usually charge you 5% interest, but in this case, we'll charge you 0.000005 interest. And you can pay it back whenever you're ready because the interest rate and the cost of borrowing is pretty much zero. At this point, the government was basically printing money in an effort to get the market back on track and prevent a total market meltdown. It looks to have worked for the most part because the market has been on a tear, businesses are open, and people have made a ton of money. And that brings us to tapering. Now, in order to prop up the market for so long, the government has been spending over 120 billion on bonds per month. This has kept the stock market going, but you know what they say, all good things must come to an end. The Fed Reserve will now start tapering off the amount of money that has been spent to buy back bonds, and this would start in November and continue until sometime in mid-2022. So in essence, the word tapering is just used to refer to the amount of money that the government has been spending to buy back these bonds, as the amount that's being allocated per month is going to taper off from 120 billion initially down to about 90 billion, and then gradually it will decrease until there's no more need to buy back bonds. So why now? What's driving this decision, and what does it mean for investors? Well, I think there's quite a few things that are driving this decision. I think the first thing and the most important thing, or the most obvious thing, would be the state of the economy right now. Because the market has been so dependent on these bond purchases for the past year and a half, if you start tapering too soon, you run the risk of sending the market right back into a recession. If you wait too long to start the tapering process, you run the risk of introducing it during a time of high inflation, which will inevitably send the market, you guessed it, right back into a recession. As of September of 2021, the US unemployment rate was recorded at about 4%. Now, this is a very big drop from the 14% that was reported during the height of the pandemic. As such, this level is almost back to pre-pandemic levels and is yet another case to begin starting the tapering process. In addition to this, the stock market is at all-time highs, businesses are reopening, operations are almost back to pre-pandemic levels, travel is more common, hotels are back open, and the number of people who are getting vaccinated continues to increase day after day. All these are good signs that the economy is in a good state to begin tapering. So the question is, if you're an investor or you're looking to start investing, what exactly do you do? In my opinion, the companies that will be the most affected will be those that have a lot of future growth priced in. Those are companies that are not yet cash positive, but show a lot of promise that just hasn't been realized yet. Now, as tapering continues and the bond yield continues to rise, people will start to put their money back into these bonds, which offer more secure returns than these higher risk stocks. Now, as far as companies that won't be affected as much by this tapering process, that would include companies that are currently cash positive and are generating returns quarter after quarter. Companies that already have a proven product, who are cash positive and are generating positive returns quarter after quarter. These include your mega cap stocks, or those companies that have been around for quite a while that have that history of returns. And if you want to be safe, the money could be put in a broad market ETF. So if I was an investor, I'll be looking at those three primary companies to invest in. So that would be companies that have a proven track record, companies that are mega cap that have a lot of cash with little debt, or a broad market ETF to make sure that you're covered. Again, this is just my opinion. I'm not a financial advisor, but take out of this what you will. Now, I like to say good companies will do great in bull markets, and they'll show you why in bear markets. So good companies will do great when the market is up, and they'll show you why they're great when the market is down. So the strategy would be invest in good quality companies so you have peace of mind that your money is invested in something that will provide you a greater return on your investment. And if those companies happen to dip in price a little bit during the tapering period, well, it's a good opportunity to get them on sale. Again, this is just my opinion, not financial advice. As always, you have to do your own research before you make your final decision. If you do like this video, please drop a like down below. It will be greatly appreciated. Again, thanks for watching, and I'll catch you in the next video.